Let's see if it works this time around.
Yeah, that's better.
That's better?
Yeah, I can hear you now. That was weird.
Okay, perfect. Perfect. Okay, I don't know, that was weird. It's a little glitchy, I guess.
Yeah.
Little glitch in the matrix.
Yeah.
Sweet. All right, man. Thanks for doing this. Appreciate having you on. Karn, thanks for being on as always. It's funny. So the way Grogu and I met, I was DMing him, or I guess we're interacting on Twitter or X, and we're going back and forth about Palantir. And then a couple weeks later, I messaged Karn, who's a good friend of mine. I'm like, hey, let's do a live where we talk about equities and investments. And he's like, I got just the person in mind. He disappears for like 30 minutes, comes back, sends me a message that he's like, I got someone. I'm like, who is it? He's like, Grogu. I'm like, the guy from Twitter. He's like, he's like, yeah, that guy. I'm like, dude, you won't believe it. I've been talking to him for like a couple of weeks now.
Yeah, we've been we've been going on about Palantir for a
Palantir and
while.
PayPal both. We've just been
Yeah,
riffing back and forth. So,
yeah.
uh,
But today we won't be talking about any of those. So
no, we'll try. I mean, we might talk about it here and there, but yeah, it won't be like a focus for us today. So
yeah, absolutely.
we'll riff a little bit. So awesome, man. Hey, if it means anything, this is our first spaces that we're doing, so it's kind of exciting.
Yeah, one of many to come, I would hope. So that would be good.
Yeah, sure.
We're just learning about the other platforms, picking them up one by one. So this is one of them that's popular. So it's great.
Yeah. Well, I mean, in this one, at least you get paid after you get enough following, right? And then you can monetize it with interactions. So, that's kind of nice.
Okay, I haven't looked into that at all though.
Yeah. But well, why don't you guys do a quick 30-second intro per person? I think most people already know who I am based on the amount of shit talking I do on Twitter. So
Yeah. Karn, go for it.
Pretty much very simple. Real estate investor, real estate consultant, and I started getting more in towards investing into different type of portfolios. One would be stocks. Talking to Grogu, learning about the different industries. It's interesting just to find the background of different businesses and how well they perform. It's actually helped me become a better realtor. So main gig is real estate. Secondary, what's the passion is doing podcasting and having interesting conversations with people like yourself. So something that I don't know, it's always good to bring somebody on and learn about their industry because somehow there's always some sort of intersection. We're always going to intersect and be able to help other people. So now it's less about me and it's more about sharing a good message with everybody else.
absolutely.
That's awesome.
Rahul, and yourself?
Thanks for sharing. Yeah, so I started off in well, I did my degree in sciences. When I graduated, decided I wasn't going to pursue that anymore. Got into business, started in the home automation, home security business. Recently transitioned into renewables, so solar panels. Like we have a residential solar company that we do solar installs. And then about 6 months ago, I had reconnected with Karn at a cousin's wedding, and I told him, hey, like this podcast stuff, like it's kind of fun. I'm a little scared to do it. Should we do it? And Karn, of course, Karn always says yes to everything. And I thought he was just, I thought he was just joking around. So one day I called him in the daytime, like, yo, are you serious? He's like, yeah. I'm like, okay, let's do it. We met up, hit record on the camera, and we started recording. And we've been going ever since. We've got 177 videos on YouTube now, probably 50 plus reels on different platforms, TikTok, Instagram, all of that. Just got really serious about investing. I want to say a couple years ago when we went through that whole blow off the top bull run. I've always wanted to be involved in the stock market and equities, but I just didn't know where to get started. And then now that I've gotten serious about it, it feels like all the doors are opening. So like X or Twitter, Facebook, all the different resources. I realized social media is a hub for learning information about things you're interested in. And the way you do it, you just follow people that are already talking about it. So that's how I ran into Grogu, because Grogu was talking about certain companies. And I'm like, this is interesting. So
Yeah.
that's a little bit about me in
It's
a nutshell.
yeah, that's actually interesting because it's very easy to like go into communities with X, I find, versus Instagram. I don't know about TikTok, I haven't used it, but it's kind of interesting. You can just search for the hashtag of whichever stock, and you'll find a community right away from top to bottom. Who are the top guys that are talking about this stock? And you can actually just engage and become part of that community right away, which I find really cool because that kind of search is not available on Instagram from my experience. And so it makes it a lot easier to find top community members of a certain stock.
100%. And even things like just the trends. So if you follow trends, anything that's newsworthy, what I love about Twitter or Spaces is the fact that I will hear about news on this platform before I hear about it on any other platform. Like if company X does layoffs, like I hear about it on Twitter, then I hear about it on news networks and Facebook and other social media like LinkedIn. So I really like that for news and for information. Like Twitter is by far the best.
Yeah, absolutely.
I should probably stop calling it Twitter because Elon's rolling over, thinking, change the name to X. So call it X now. So
yeah, absolutely. No, that's cool. I mean, they all have their power, I think. Even LinkedIn, you can find some information there that you can't find on X, and then vice versa. I think it's like they all have their thing going on. So it's kind of cool how we can just but when it comes to like a short message or something that needs to be like tweeted or like sent across, I think Twitter is probably the fastest when it comes to getting something across to the masses.
yeah, 100%. 100%. And then it allows other people to engage and interact with you. So anyways, cool. So that's good for the intro. I guess we can kind of dive in. Karn, when we were talking about, equities and companies and investments, your name came up. So, in the few conversations that we've had, I've realized that you have a passion for equities or stocks or investments. So naturally we've connected in that way. So I'm like, man, we're already so similar. We riff on PayPal, we riff on all these companies. Why don't we actually just do a Spaces and actually talk about the stuff? And really what I'm hoping is that, one, if I can learn something from this call, then it's worthwhile. And then usually if I learn something, not saying I'm smart or anything, if I learn something, then hopefully someone else will as well. And so, thanks for making the time to do this because I really like to learn. So it'd be fun for me.
Yeah, thanks for having me too. Yeah, but go right ahead. Whichever questions you guys have, I can answer, and I may have questions for you guys as well. So let's start this.
Perfect. So, dude, like my first question is probably more about you than investing, and then we'll kind of go into it. So you don't have to go like crazy in detail. My first question is, how did you get started, and how did you get here?
Um, I would say I started with just testing softwares. I think I've mentioned a couple times already on Twitter as well. Uh, just being a user of all new software that are somewhat in the construction side and the animation rendering side. Also learning how the power of GPU affects gaming and the rendering of gaming and how an actual chip can actually speed up your animations because we were doing a lot of animations and rendering for construction for doing presentations for the clients and stuff in in architecture when I was doing that. So what I didn't realize was that I could actually take that knowledge and apply it to investing by actually taking that same beta testing skill that I have into different sectors. So I was doing that all across the board for the last since I was 17 all the way to after graduating and even in college and then for my work as well. But I just didn't know that I could just, what I wasn't doing was taking the software, applying it, and understanding that software is created by a company for which there's shares. And then if the software does well, so does the company. I just didn't know how to invest until I learned about how to do that at age 30, 31. So from there, I've just been kind of going up.
Right. So you actually started pretty late. Like you started investing at 30.
Yeah, I would say that the tech learning started super early all my life, but the actual part of just learning to buy stocks was in my early 30s. I would say exactly at 30.
Why was there a lag between you learning about the companies or learning about the different types of products you're using to eventually investing in different companies? What was the lag?
I think growing up in an Indian family, you're not given these skills, or unless your parents are part of the financial market, you're not going to be exposed to some of this stuff. because what we're taught is go work 9 to 5 and then make your money, and there's no other way to make money. Um, so, and then even the friend circle that I had, a lot of them were not really into stock market. They knew about it, but they couldn't give me the details. And I'm the kind of guy that when I learn about something, I break it down to a point where I want to know everything about it. That goes to converting from Canadian to US, the currency rate exchange, to buying the stock, with the differences between the premiums of the two, and what it takes, and how does the US market affects the stock market, and how does the Canadian market affect the stock market. So I start going into those details, and then once I learn everything about it, then I get a grasp, because I'm learning the way I want to learn it. When I ask other people, they would just say, "Oh, just buy the stock, go to your bank and do it." I'm like, "Okay, that's not enough. There's so much more you can learn." So I learned the hard way by paying premiums at the beginning, conversion rates I didn't know much about. I learned all that on my own by making all these mistakes. And then from there on, I was able to pass that knowledge off to the next person, whoever wanted to buy stocks, and teach them that so they don't make the same mistakes I make. So I've been able to pass it on to anybody, but I can't continue to do it because it just takes too long. So I've just been focusing more on just kind of just getting better at learning myself.
What's the
What
eventual goal?
Yeah.
Like you've taken all this information, you've helped a few people out. What's the eventual goal of accumulating all this information? Are you going to put a course together to help more people like us?
Absolutely not. No courses, no nothing. All I'm really doing is making sure that I know when I have capital where to invest it. That's all I care about. If someone wants to learn something off of me, go right ahead. But like, I mean, I tweet my thoughts all the time, so, or post on X. Like, there's enough to go learn on there, and there's a lot of other people that are willing to teach for money. So, no courses. Sorry.
Yeah.
Yeah. So, question for you. So, the way I found out about investing, my one of my first jobs was a retail job. I worked at the Apple Store, and while working at the Apple Store, one of the managers came to me and said, "Hey, you can roll in part of your income into the Apple stock, and they'll match it up to like whatever 25% of what you put in."
Mhm.
So that was my first investment. Was actually me being an employee at Apple, and the manager talking to me about rolling my money into stocks. Do you remember your first investment?
The first stock was IBM that I ever bought,
Mm-hmm. And did you
which
buy it because like you researched it, or you looked at fundamentals, or someone just told you to buy IBM and you bought
I just looked up. I was just all big about quantum computing and AI stuff back then, and I still am. So they were up there with quantum computing. So I was like, let's just buy IBM. No research, no nothing. I just bought the stock.
it?
Luckily, I made money off of it, but it wasn't like researched, well thought out. I just bought it for the sake of buying it. But yeah, that's it. There's no other
Okay.
story than
Now,
that.
normally when like people start investing, they'll either pick up a book, the typical Tony Robbins, Money Master the Game, or some sort of Warren Buffett book, Intelligent Investor. They'll pick up one book and go through it where it talks about, things like dollar cost average or buy the indexes. Was there a book that you reached for, or?
The book I reached for was 0 to 1, but that was like later on, not at the beginning. At the beginning, I wasn't really doing this. I was doing more. I'm a firm believer in the hands-on learning, that you learn more when you're in the field versus reading about it and then applying the knowledge after. But I think you make the mistakes at the early stage. So I started with learning to trade first, how to actually like measure a candle, like how to do all that. So I was taking YouTube classes, this trading 212 course that was available for free on YouTube. And anyone who was teaching how to like just learn how to look at a chart, I needed to learn that first. I started
Mhm.
learning that, and then from there, I kind of went on to actually like get into the details. So as I'm doing the charts and I'm talking to my friend who I knew, call them up and I'm like, hey, there's probably a way to like, I'm buying this stuff, but there's probably a way to like check out their finance and stuff. He's like, yeah, you can. There's like reports and stuff you can go over. They come out every 3 months. So I was like, okay, so where do I go? And he's like, yeah, you can just like Google it. I was like, okay. So you start looking up stuff on Google, and then you start from there, and then you run into a bunch of people that are just on YouTube just discussing this stuff. But then it's always like not the perfect information, because someone's giving certain information and then it's always not always correct. And it is. So you really have to like always verify yourself by checking the data. So you have to go to the SEC filing, you have to check this stuff, and you have to know how to do this stuff. But that came later when I
Mhm.
started getting more into the investments and stuff. So that came later when I started buying Tesla, because a lot of people were scared to buy it at a really early stage. This was like pre splits. I think it was 2018, 19. everybody was shitting on this stock nonstop. And then I bought a little bit, but then the thing is, you're not inspired to learn about something until you actually have skin in the game. So you
Mhm.
buy a little bit, and then you're like, okay, now I actually am incentivized to go learn about this. Don't put like the whole pot in there, but like a little bit. So 10%. And then I had a friend who was really good at teaching me this stuff too, like kind of explaining things to me. And he just told me, he said, what you have to do is buy a stock and then go learn about it. And then as your conviction goes up, keep adding to your position. But if your conviction goes down, decrease your position. So I kind of did that. I ran with that model. And then I kept doing that over and over again. If something really looked not good for me, then if my position 50%, I would drop it to 40, regardless of the price, because I'm just trying to like manage my own portfolio right now. So that was like my way of starting. And I kept it very simple. Just one stock one time. And I still do almost the same thing, except I can kind of take that same model and apply to different stocks.
So when did you start going into the finances of these stocks? Like you started with dollar cost averaging and just managing your account. You obviously have a little bit of conviction in that company now, but what were you doing on the back end of them to learn more?
The three things before the finances, I started actually talking to the customers. So there were people who were driving the Tesla, and I would go to them because you would hear things in the news. Oh, this car blew up. This happened. That happened. I'm like, okay, fuck. Like, let's just see what happened, right? So I go talk to a customer, and I'm like, I roll my window down on the road, and I talk to them like, hey, is there something wrong with this car? They're like, no, we love it. I was like, okay, is there anything you're complaining about? He's like, no, it gets updated all the time. Everything is great. We don't even pay anything for gas. I'm like, so what's all this complaining about? And they're all just shaking their head. I'm like, I don't know. I was like, okay, that's stupid. I mean, it doesn't make any sense. So you hear something from the customer, and then based on that, I'm like, screw this. I'm just going to buy the car as well. So I bought it, locked in FSD. I have the software, and now I'm getting full exposure to the technology. So again, I am that same person who's beta testing a software again. So I'm out there just learning about this thing. And if the update comes, I get it first now. So I get to see if it's actually doable or not. So I was blown away by what they were doing with this, with the tech stack of Tesla. And then as that got, as the product kept improving, and then the sales kept going up, I just kept buying the stock nonstop. That was my conviction at the beginning. It was simple, but I should have also gotten into the finance details after. But I got into that afterwards. Then I started looking into sales, their margins, and all that other stuff. But at that time when I was investing, they weren't even profitable. Like, so it was a lot more riskier back then than it is now. But in order to get anything in the stock market, you have to first understand the product. If the product is good, then you have to find how it scales. How does it get its distribution? How fast is it moving? How is it compared to other cars? And how do you compare it? Do you compare it to a car company, a gas company? Do you compare it to tech? It's very hard to analyze some of these things because there was actually no EV market. So Tesla was creating their own total addressable market with EV because nobody else was out there. And then the chargers went off all across the board. They were growing like exponentially everywhere across states, across Canada. And I'm taking road trips and I'm going to these states and they keep adding more and more and more. There has to be a mode here of something, right? Energy is going up. So it was a lot of it was based on the fact that I was using a lot of this product. So I was 24/7, I was working while learning about the product, while investing into the company with whatever money that I had on the side.
Right, right. That makes sense.
So, like, one of the things, especially, let's say that particular investment, like at that time, 5 years ago, 2018, 6 years ago, like the green movement wasn't where it's at today. Is that something that you like factored in, or did you know it was coming?
Not at all. I
No.
just no, nothing. It had my investment had nothing to do with saving the planet. It was all about this car is a really good product. It reminds me of the iPhone, and no one is building a car like an iPhone at this moment.
Mm-hmm.
And then the key was they were removing parts on the go. That's all it was. And it just seemed sticky. And once I got in that car, I went back to a gas car. I just didn't want to go back. And I'm like, I can't. It just doesn't make any sense. Automatically at 6 a.m., I preheat the car gets ready for me. I don't have to do anything. It was just at 5 years ago, this was like 2019 model I have now, but like that was like a luxury thing to have. And you can't go back because in the wintertime, you just heat your car. You don't have to start it. It's just like it's ready for you every time. And people complain about gas station. I'm like, okay, you have a plug at home. Like, you just plug it in and the thing in 5 hours ready to go. So you go to work, you have 300 something kilometers, you come back, you maybe spend 60 kilometers or maybe 90, I don't know. But you come back and you plug in, the car is ready, full charge, fully loaded with gas in the morning, or be charged, whatever it is, right? But the idea of me just filling up gas and going to a gas station late at night or early in the morning before going to work just I hated it. And I felt like that was more than enough to like get this car. And then if that same experience was given to somebody else who's trying to just get to work, I felt like it was valuable. It was just a very special product to me, and it's one of the biggest reasons I invested.
Mm-hmm. Do you still try to buy the product from the company before you invest in it? Like, I know
Uh,
some companies you're just not going to be able to do that, but is that kind of like a theme for you?
Ideally, that would be what I would like to do. That's what I do like to do. But then, yeah, some companies you can't, because what your best bet is to ask the customers and then get feedback from the people who are using it. Because before I had the car, that's what I was doing. It's just that I had the option to buy the car, so I did it.
Mm-hmm. Yeah, yeah, I would say that's pretty early on the green movement, right? Because that didn't start until maybe it did start around that time. So you kind of have to see that coming. But
Yeah.
with your logic, it makes sense. Just like the vehicle first.
Yeah, the product has to be good. If the product is shit, I mean, if you're not convinced on the product, why are you even buying, bro? Like, if you're not using this stuff on a daily basis, if you don't know people around you that are not using this stuff, or you hear anything from anybody that's saying, oh, this is such a great product, I love it, it helped my business in such a way, why are you buying?
Mm-hmm.
Right.
It sounds so simple, but harder to practice, I guess. Hey, so one of the things that you talked about was like buying, um, let's say Tesla in this case. You were talking about buying shares early on, and then buying more and more whenever you could. Now we know in the finance world that's called dollar cost averaging. You almost learned that without having to like read about it. You were just doing these things, and they were just working out the way you expected. Is that part of that experiential learning that you're talking about?
Well, dollar cost averaging is very, very basic. It's just that when you listen to somebody, even on YouTube or your friend, and 2 to 3 people say the same thing, dollar cost average, your closest friend is saying dollar cost average, and you try to like grasp what he means. Because dollar cost averaging could mean that if you have 10,000, you put in within the span of 10 months, you put in $1,000 every month. Or it's 100 every month. But you decide based on your risk factor, like how you want to divvy it up, right? So in my example, like when I got in pre-split, Tesla was around like 290, 300, and it ranged to 200. Oh, sorry about that. I think close to 220. It was ranging around those prices. So my goal was that between those two prices, I'm not going to go all in. If I start at 300, if it goes up or down, I don't care. If in the next month my conviction is higher and it is below my dollar cost average today, so that means if I got in at 300 and the next day it's 280, I'm going to buy another 10%.
Mm-hmm.
And then eventually what you have is you have a range between 300 and 200. And what you have is your cost could go all the way down to 200 or 180, maybe even if it goes that low, just based on your 10%. So you're now between the high and the low. And then when this thing does take off, and it did past 300, 400, 500, then 1,000, then 1,500, then 2,000, then you're just laughing. So all this stuff about, oh, I got in at $5, I got in at $2. If you sell here, you can. None of that stuff matters, because when this thing actually takes off, it doesn't matter where you got in. It's just like you got enough shares at a certain range, and there's no way an expert, even if me being in the market for maybe even a decade, sure, once in a while I can time the market, but not always. Your best bet is to just have conviction on a stock and to start to and decide how many shares do I need to make a difference in my bank account that's actually going to impact me in the next 4 to 5 years. And then you accumulate. That's all you can do. That's it. You can
Mm-hmm.
trade in and out all you want. Oh, sure. After 300 goes into profit, you're eager to sell now. Fine. Sell 10%. Don't sell at all. Reward yourself a little bit, right? You can. And then you have 90% of the position, right? And you have 10% cash. It goes up, drop a little bit. Now you have 80% and you have 20% in cash. So not only are you dollar cost averaging in, you're also dollar cost averaging out
Mm-hmm.
if you have a plan. But then don't do it if it doesn't hit. If your price is, if you got in at 300 thinking it's going to go to 600 and then it goes to 200 and now you're panicking, now it hits 300 and then you're just like, oh shit, now it's 300. I just made profit after 2 years. I mean, why did you even get in at 300 if you're going to go down and go back to 300 and sell at 310?
Mm-hmm.
Right?
Yeah.
Makes absolutely zero sense, but that's psychology. This
Right.
is what happens every market. That's why when you see that's why every time you see a stock go up to 300, there's a bunch of sellers out there because majority of them are just like, I can't take this anymore. I'm just getting out. And then you have new buyers and new sellers, and then it takes off and you're just sitting there. Oh my God, I should have just kept it.
Mm-hmm.
So this happens. This happens to good stocks, not all stocks. So the companies that are really, really good, it happens. There's parabolic movements that happen in the market, and everybody misses out because they're just too greedy. Either
Mm-hmm.
cashing out, they go off of their plan. They start handling greed is one of the hardest thing in the market. Like when you want to sell, you don't sell. When you want to buy, you don't buy.
For sure.
Yeah, that makes, like, psychologically, that makes the most amount of sense.
Yeah, I was gonna say, so like the biggest thing is that the conviction has to be there. Do you have like a set of things that you look for to know whether your conviction's high? Because I think that would be the biggest hiccup for most people is they can have conviction in the wrong business and that business goes down, right? Or
Yeah,
doesn't do well. So what do you look for in a company?
I look for a company that creates their own total addressable market, a niche product. A majority of this is all from like the book 0 to 1, but not all of it, I guess. But you have to look at it in a way that is this product good, and are there competitors, and are the competitors as good, or are they not even close? So you have to base it off of that. But in order to figure that out, you have to know that sector, that market, see what's going on and what are the clients saying. There's all these things that matter, right? Of course, there were like Tesla cars at that point. There were other EVs as well, but they weren't those EV companies weren't building factories. They weren't spreading out their charging network. They weren't developing their own software for energy management within the car. And if you touch the two products and you realize that this is shit, that is not, that's usually the conviction rate that you have just based on the use of the product. And then from there, if the founder is good and you trust him and then he seems like he's delivering what he's saying, late or not, overpromise, under, it doesn't matter at the end of the day, as long as he's delivering what you're expecting from him majority of the times. I mean, he doesn't have to deliver everything, but if he's delivering 80% out of the 100 or 75 at least, like, it's pretty good. Because founders and CEOs, they overpromise on purpose so they could stretch the employees to reach higher. So if you don't aim for 70-80%, you're gonna only get like you're not gonna get much. You have to
Right.
expect, you have to like shoot for higher, and then you might get the most out of your employees that way. So CEOs do that. So you have to kind of understand that as well. And then you're betting on the guy who's running the horse. So Elon was like, he's well known. People hated him, loved him, but at the end of the day, did he reverse land rockets? Yeah. Did he is he doing crazy things that are actually working? Yeah, he is. And proof is that I'm using some of this stuff, right? So usually that's how convictions happen.
Mm-hmm.
But if you go into a
Have you
company where, yeah,
have
go
you
ahead.
had conviction in a company that didn't pan out? Like we know we have the Tesla example that panned out really well. Have you
Yeah,
had one that didn't?
yeah. I had conviction in Square in 2019
Mm-hmm.
because they got a bank charter in 2020, meaning that they were one of the first fintech companies to get a charter. So I felt like that was a big deal because I was really big into fintech around that time. So it took off, and then Square was like my thing. Cash App was bumping at that time, and then you had like just terminals everywhere. Everywhere I went, everyone's using Square. It's still going on, and then you start seeing Clover here and there once in a while, and then high conviction on it. But I think at a certain point, I started noticing that there's so many competitors in that market that it just didn't make any sense for me. Like it can definitely go up, but then there's so many players in that sector: Stripe, Shopify, PayPal. There's just tons. So, and then Clover, there's private markets. There's just everybody's a terminal nowadays, right? So I'm just like, yo, like they're just gonna get their margin shaved away eventually. So why am I even bothering with this? So it didn't make sense in a way that yes, I could make money, but it wasn't gonna make me astronomical amounts that would actually make a difference in my life.
Mm-hmm.
And that's one of the reasons I didn't bother. You can still make money, but is it good enough for you to actually put enough money in there that you think it's going to actually do really well in the 5 6 years to a point that it's going to like change your bank account from like, I don't know, 500 to 2 million or 3 million or 4 or 5, right? If it
Mm-hmm.
doesn't, then is it even worth it? I don't
Mm-hmm.
know.
Yeah. So my question is like, because if you look at like the Warren Buffetts, their investing strategy is more compound long term than the exponential growers in the short term, right? That's kind of been Warren's philosophy for a long time. And what you're saying kind of really contradicts that. Does that just speak to your risk tolerance, or do you just have a different perspective on the market?
No, Warren does similar things that I do. He also looks for competitive advantage in a business, but he just does it in numbers. He'll look at a company and he needs to figure out that if their gross margins are high enough to actually separate them from the market, and are they profitable or not. So in his book he actually talks about that. He's like, you want a business that cannot be, that margins can't be taken away from, that their product is so addictive and so good and it's used every day, that the advantage is like higher. Yes, he invests in other stuff too, but he invests in sectors. But his thinking is very similar to the way I'm explaining this, just having a niche market where you're going to be not being outcompeted. So even stuff like Apple that he bought recently, he bought it thinking that there are other phones out there, but at the same time, people want this product more often. And ever since, you can check the date, ever since he bought in, it's just been like, it's probably his biggest investment that he made. And he's made the most out of Apple because he was thinking the same way. Because he kept thinking that they're going to be keep adding more and more products on top of what they currently have, and they have been.
Right. But I mean, even his philosophy, like that is true. He does look for that differentiated product, but he didn't get into Apple till like very recently, like within a few years ago.
Yeah, he waits. He's patient with the timing and when he can and cannot get in, and then he bases it off that because he knows he's not much into tech. He only invests into stuff that he understands. Tech
Mm-hmm.
isn't really his thing. It's probably why he missed on Amazon. He missed on so many tech stocks out there, right? So we know that of Warren Buffett, and he says that as well. So I don't think I'm any different, or anyone is that different, because it would be saying that I'm buying something that doesn't make any money or can't make any money. I'm still buying a niche product, and I'm still buying it based on, can it scale, and is there a difference between them and the competitor? So
Right. Now, do you diversify your portfolio at all, or is it just like a few names that you're all in on?
I don't. I just diversify in different markets. So stuff like, I'll have real estate, I'll have cash, and then I'll have um, maybe other asset that's generating profit. I don't know, money on the side, but just depends how much capital I have. But if I have a high conviction on a stock, I'm probably going to concentrate majority of the stock money in there, and I won't diversify within the stock market, except it'll be the stock and cash position.
Mm-hmm.
And then you have real estate and cash position, and then you have your spendings and whatever, all that other stuff on the side. Or if you may have a job, you can do that as well. That's usually how I do it.
Right.
Hey, so I got a question because you just mentioned real estate, and that's kind of the realm that I'm in. Do you notice a correlation with what's happening in the markets and real estate going up or down, or the markets going up and down, like people shifting their investing habits based on what's happening in the market?
Here, that I do notice that when the market goes up in the stock market, the money usually, a lot of the times, a lot of people cash out, and then this real estate market starts to go up. So it's like a pattern that I've seen in the last 6 7 years now. But I think a lot of people have seen this. So market go up as interest rates start to drop a little bit, right? And then as the market goes up, and then you have this overexposure, and then people start cashing out, and then the money starts to flood into the real estate market.
Okay.
That's usually what I've seen. And lagging indicators, same way. When the other market goes down, it's the same thing. It's always like the real estate is always at the end, because it's not liquid; it's illiquid assets, right? So it takes longer to get rid of real estate than it does stocks. Liquid
Right.
markets always get taken out; they always get sold off first.
Would you ever consider just swapping what you're doing with stocks and going into real estate, or do you think that's something you're not interested in?
Not interested in it. The returns aren't there for me.
Hmm. What would you say if the average person? So, one question or one thought that I had in my mind is one way I actually got into investing was, again, it was from my company. They were giving stocks, giving shares. And then I went to the bank one day and I asked them, like, hey, what's the potential of me making more money or diversifying? And they told me, let's get into mutual funds. And there's going to be three different sectors where uh, it's going to be a little bit safer. Then there's a medium risk. Then there's a high risk. And I said, let's just put in the high risk. 6 years later, I came back to this mutual fund and there was barely any increase in the value of it. And I just thought, why would we ever go to the bank if they're not even, if the, whatever selection that they're making, they're taking a piece off the top, and I haven't even made anything in 6 months. Like, how do we get people more educated in the idea that maybe these mutual funds that these banks are selling us, these ETFs, are not the best?
Yeah, that's banks have a job to do. They need to sell their own mutual funds and ETFs. You kind of don't even know what you're getting into with them. You have an idea, but like they're controlling it. So people do make money on them. Which is dependent on the market. But I think people should actually just try to like study businesses on their own, because I think there's very valuable lessons you can learn by just focusing on one business that you learn everything about. And then from there
Yeah.
you can spread out, right? So because then you learn about balance sheet, you learn about cash flow, you learn about margins, how people get out competed. When you learn all of that, you can just apply it almost anywhere. Because even when you go to a job or even real estate or a real estate company, they're gonna have the same metrics. It doesn't change. They
No.
have margins, right? They have cash flow. They have balance sheets. Everything is there. So if the common denominator is finance, it's best to learn finance.
Right.
So like even stuff like stock-based compensation, like you sit there and you're like, okay, you're doing stock-based compensation, but you're diluting the shares. So should I buy shares or should I work for the company, right? I always say that if there's a company you love, you like, and you wish you worked there, then even if you work somewhere else, the paycheck, a portion of that, put it into that company's shares if you love that company that much, because technically that is the equivalent of you working for them.
Yeah, I guess that makes a whole lot of sense because the returns at the end of the day are as if you're working for the company just because you like them.
Yeah, so paycheck not doesn't matter. I wish I was working for, I don't know, SpaceX. Okay, great. If you can invest in Starlink, SpaceX, dude, just take your check, cut it in half, put it there. But people don't. And then people also look at their jobs as if like even getting a job is like, and I've mentioned this to many people before, is like, even when you get a job, it's you're making a bet that the industry that you're in is going to continue to give the same amount of margins in the next 5 6 years, which is no different from you betting on a stock. What's the difference?
Yeah. I can see that happening.
So it's always risk, always opportunity, and then even in real estate, it's like it's the same thing. Even when you're like looking for a property, you're basing your judgment on like, okay, so eventually there's going to be a town that's going to get built here. There's going to be a mall. There's that. You're speculating on the fact that this is gonna happen. It may, it may not. You could still have issues. You could have interest rate rise, and all of a sudden that all slows down. Now your money's in limbo for the next 5 6 years because they haven't started building yet. So
Right.
everything is a startup, and then these builders need startup money to fund the project, which is no different from someone going starting a company saying, "Hey, I need to build this product, fund me." So
Yeah.
you get your seed rounds, right? It's the same thing. A very similar concept here. It's just and it's all finance at the end of the day.
Okay. There's a couple companies, big companies. BlackRock comes to mind. I know Berkshire Hathaway comes to mind, and then also Kathy Wood's ARK Investments. They have something that they're doing. Is one person's word or one person's conviction better than the other? They're all relatively doing well in their own kind of sector, in their own sphere. But is there one company outside of you just liking what they have to say, or maybe you like the person better? Is there something that we should be looking in towards to get a better grasp of trying to make the most amount of margins?
I don't know if everyone's an expert because the minute they don't do well, they don't look like experts. So it's I don't know. BlackRock has some questionable investments, so does ARK. So you kind of have to understand what field you're in and what your value is and what product actually makes sense within your circle of understanding. And you have to base it off of that, I think. And then that varies for Rahul, that varies for you, that varies for me based on my experience. So if I'm into tech and I've been using nothing but Adobe and Autodesk and just these other products, I can only do that. But if you're in real estate and you see a product come in that you're using, and then all of a
Yep.
sudden this product as a company and it's actually helping you, and then you don't know any other product that's as good, dude, that's like an investment. That's like your clue that you get while you're living your life. So even with Rahul, he said he's in solar. I'm sure he's going to know a little bit more about solar than the most of us. And he's going to see competition taking his margins, then he's going to see, and that to him, maybe that's the opportunity to know where to invest his money. Yeah, sure, they might be taking his company's margin if that's what he does. But then he gets an idea of like, okay, so this company like Tesla or Enphase, they're taking over. I should probably invest in there, right? It's based on like what your expertise is and what you understand. I'm not going to understand that. Rahul is, his conviction is going to go up because that's his field, not mine. So if he tries to tell me that, hey, Jimmy, you should get into it, I'm taking his expertise and applying it here.
Okay.
But I will not have the conviction he has because he has first-hand information and he knows exactly what's going on. I don't. So same applies with me with my sector. Same applies
Right.
to you with your sector. So listening to these guys, I don't know, man. Like I just don't think it's that. Just listen to them, but like I wouldn't like let everything go in and just it's like garbage in, garbage out to me.
Okay, cool. Anything technical that we should be looking out at when we're reviewing charts, especially with a one company that we're working with? Is there anything that should come up in these indicators if the stock price movement is going to go up or down? I know this is kind of tough, and I should try to learn how to rephrase or reframe it, because just looking at the market going up or down, or the stock price going up or down, that's one way of like looking at the thing. But at the same token, it's hard not to look at those things because there's different terminologies. You can see a company flagging after a couple of months, a couple of years, and you're dictating the price of where it's going to go without looking at the financial statements. But is there something that does stand out that we should be looking at, like at the bare minimum?
Well, there's two things I look at. I have potential market cap of the business. So where can they go? So if they're, let's say 30 billion today, like can they go to 500 or 600? How are they going to get there? And just reverse engineer it, meaning that go and then work backwards, right? Like how would they get there? And are they actually taking those steps to get there? Other thing is when it comes to stock indicators, when it comes to trading, I do look at moving average because I have noticed that some of the entries that even Warren Buffett made are usually around when the RSI is like super low on the weekly basis, and then the price is way below the 200 weekly moving average. So there's an average price per day, and then there's an average price per week. So the candle closes for a week. That what was the high of the week? What's the low of the week, right?
Okay.
And then based on that, there's an average, and that line is drawn across. And then usually when the price is lower than that, I kind of see like an opportunity there, but not something concrete. It could still go lower, but you may be getting the best deal available for the time being. It could still go lower. Don't get me wrong, but if it's not at the market cap you think it is, and it is below the moving averages weekly, not daily. Okay, daily's too quick, then usually you kind of say, okay, fine, it is below my averages. I think I should buy in a little bit, right? Not all, but you buy like a portion, maybe more than, maybe if it's 10% normally, you do 20 or 30, right? So I do that.
Okay.
But that's with experience though. So you have to kind of like keep an eye on it and a lot of patience. You have to wait for those opportunities.
Okay. So one company specifically I want to talk about, because we're talking about RSI right now, was a company called SoFi, or is called SoFi, I should say. And they just kept going down. I think they're down 80% of what their ultimate highs were, or maybe more, maybe less, somewhere around there, because I haven't checked for a long time. But
Yeah.
they continue to go down. Now the opportunity was there. It's what all the people were saying. I just didn't know how to read the charts, but I kind of monitored it because I wanted to know what was going on. They just never recovered to their highs.
Yes, some of them do, some of them don't. It's like a business that's a startup that it still has to be profitable. It is a lot harder for them to go back to their original prices again. They have to do a lot more. But if it's like a blue chip stock and they tank and they're still like making tons of money, more likely that's going to go up. So when the market tanks, I always say go for the blue chips because you're guaranteed money there. So the Apples, the Amazons, the Microsofts, right? So you go from there and then you allocate your risk based on the other stuff, right? So you can kind of do that. But will it return well or not? I don't know. Like I can kind of look at the moving average right now and get an idea of where it is, but it's Like it's right below the moving average on the daily. On the weekly, it's right at the 50 right now. So it's like it hasn't actually gone. I think it hasn't gone down enough, to be honest.
Oh, really?
Yeah, not that I'm saying that's gonna happen, but like it seems like there isn't like it's it's one of those companies that's just it's just too dependent on loans,
Mm.
like a lot of loans. And then if the if there is no interest rate drop, even if it goes from 5 to 4.5 or 4%, that's still not enough to actually make a difference because the interest rate is still high. And then what are the chances of them, the people who they're lending to actually pay them back, right? Because there's going to be defaults. And if you're lending them at a high rate and then the interest rate drops, now you're making your margins. What is the guarantee that these people are going to pay back?
There's no guarantee.
Yeah, so that's what really like it's tricky with these businesses when it comes to like this fintech and borrowing lending because it's too codependent on the interest rates and somebody else doing you a favor before things actually recover. Where a business that's already healthy, has cash flow, has a really healthy balance sheet, they're more likely to do even better as the interest rates drop versus a company like the company that isn't profitable right now. The unprofitable company is more likely to go into the tank than actually do well. So you have to base your risk off of that. So maybe if you have like 100K, you only do 5,000, which is like 5% of whatever your total net worth is, right? Or if it's 100K, I'm just saying, right? Or maybe 1%, right? You have to learn how to allocate your weights based on your net worth. So you have to work
Right.
that way. And then
Does your based on your weights, does your 20% cash or how much of a money value that you're sitting on, does it always remain the same or does it go up or down? Like, let's just assume that it drops down to 15%, the values of shares go up. Are you trimming to bring it back to 20% cash value?
not always. And if it reaches certain price targets, then I do it. What I do is I set goals on me. Like if I have this much money, I'm gonna do these things. Either pay off my car, right? And then I have all these things written. When I'm capable of doing things, I will shave a little bit off of my position. So I do keep two positions. I keep one long, one for trading because there's always that itch when the market takes off. You're like, oh my god, I need to sell now because the market is up and I made so much money. But it could keep going up or it can't go down. So you have to have like one side. So if you have like 100% position, you take 80%, you put it all into the stock, and then you have that 20% position, which is cut in half, 50-50, so 10-10, which is your trade position, which is 50-50, and then you can move that around. So if in your trade position the stock goes up astronomically, then you can bring it back to 50-50 again, right? Because now what you have is more cash and you still have the stock. So you fight that itch that way. You always keep a side trade position, but don't let go of your long-term investments that you think are going to do well, because when the actual market takes off and you get like a run up like Tesla, you're going to just slap yourself in the face because you didn't hold on, right?
Right.
So
That makes
you have
sense.
to so you got to have that balance between the two. And I think that's one of the best ways to fight that greed of selling. You just have to have a trade. And it's nice when you have a big trade position, like you're not a small trade position, you're actually a 100K trade position because your actual long is way bigger than that. And then you have 50K to play with. It's really nice to have that luxury. But then you have to practice with 10K, pretend like they're 100K, and then you start to apply the same fundamentals to when your capital grows. Because if you start like dicking around um, with low capital, with if you don't treat your $1,000 like 100,000, then you're never going to treat your 100,000 like 100,000. You're still going to treat them like 1,000. So you have to build these habits on the long run.
Right. I guess it's easier when it becomes a little addictive when the money comes in and then you just don't know how to position it in and out.
Yeah, management is like the hardest thing I think that people have trouble with. This is just knowing how to allocate percentage wise. If you can figure that out, you'll do well. If you still are just like thinking that, oh, buying this at certain price and selling this at this price will make it, you're never gonna get anywhere. You may hit like a lucky one here and there and feel like a genius, but overall in the long run, it's not gonna work.
Okay. There's two questions I have, and then I think Rahul has a question as well. So there's a potential of a recession that they keep talking about. That's number one. Number two is a lot of companies are cutting down on their expenses, and their biggest expense is their employees. Are those two correlated of the market possibly tanking and because of the recession, and so they're just cutting their employees, or are they just two separate issues?
Like, I'm not an expert in this, so I will just give, and I'm not gonna create a word salad to like talk about recession because I'm actually not an expert in this stuff, but I just think just based on what I've seen in the past, usually companies lean down just to increase their revenues. So as they let go of the employees they don't need, which every company should, they should let go of things, the people that are just taking up too much money and free up as much capital as you can and allocate it properly. There's nothing wrong. They should be doing that all the time. You
Right.
shouldn't be you nobody. There should be no one that is unproductive that should be working for the company that is not actually bringing value in. And if that is what's happening, you got other problems to deal with. So that's how I look at it. I mean, you wouldn't give your money to somebody who's not going to be productive. So why should a company that you're investing in?
Yeah, that makes sense.
Rahul's been quiet.
Yeah, man,
Yeah,
Karnvir on a roll. I've just been letting him riff. That's part of this. Part of the reason we're doing this is to allow him to develop his thoughts and stuff.
I'm sitting here taking notes right now. I got so many
What
notes. This is good.
At what point do you change your thesis on a company? Do you revisit a company every couple months and say, "Hey, have things changed? Do I still want to own this business?"
It's like that's a hard question, which is good. I think it's mostly got a lot to do with competitors. If there's a competitor that is actually legitimately taking over that market and that product is that good, I get concerned then. And then I think twice about it. And there's a chance that I might actually split my value into the both companies because now I don't know who's going to be the winner. Like
Mhm.
there's two now that are attacking the same market. But if there's three or four or five, now I don't know what to do because I don't know who's going to take the market. And that's when I'm out.
Right. Now, I think the as you get kind of more deeper into certain technologies, it gets a little bit more confusing, right? You start to have companies that have a do it for you model, and then there's other companies that do it for yourself, but we give you the tools to do it. Do you ever like play around with those thoughts of like which way would succeed on a bigger scale?
I think based on data protection in the future, it is best to give the business the tools because there's going to be a lot of lawsuits on who's using whose data. So the best thing you could do is give them the hammer themselves and they can utilize it as the best they can. Because here you get to build your own house. We'll give you all the everything you need to build it yourself. So you can't come back to me and say that I collected your data.
Mm-hmm.
The company that does it best is actually thinking about what's going to happen in the future because you're going to have API lockouts where people will not be allowed to use data. And you're going to need tools that do that, that allow you to control those. So I kind of see it that way. Where if you were talking to me 5, 6 years ago, or 7, even 10 years ago, I would not be saying this at all. Because back then, it wasn't that big of a concern. Because
Mm-hmm.
everybody was collecting data and that was the moat. Now, whoever is collecting data is a liability.
Right. I mean, even the sentiment around, free speech, all that's kind of changed in the last 5 years, right?
Yeah, it probably would. I think they're gonna have to figure out a way to identify who's saying what because you got deep fakes. You have all these bot accounts that are representing you, which is not even you. So there's a way they gotta authenticate. If I'm tweeting, I have to do a digital signature somehow, even if it's biometrics on Apple Pay. Or like if I tweet, I get a Face ID before I tweet it just to make sure it's actually me, and then it verifies this person did biometric Face ID before they tweeted this. Now it's confirmed.
Mm-hmm.
So those things may play out later. It slows down the process of you sending a tweet. But if you think about it, for payment on Apple Pay, after the Face ID is checked off, biometric done, you paid, right? It's the same thing. Take the same concept, apply it to a tweet.
Right. Right. It's cool. It's cool because a lot of these spaces are changing quite a bit. A lot of these are changing with technology. Um, so it's part of it is trying to understand where the world's going and invest in companies that are building the future, right?
Yeah, it's hard. It's very hard to like figure this out. So I'm not even 100% on it, but like you just have to make the best judgment based
Mm-hmm.
on where you see things are going, right? But usually it's a trend you can pick up. By the time everybody else figures it out, it's almost too late. So you kind of have to be ahead of the curve.
Right. Do you ever look at like tertiary investments? So for example, let's say AI is technology of the future, right? Let's say that's a big investment theme that is being followed right now. Now everyone again will rush to these AI companies. Do you ever think like, oh, what do these AI companies need, and invest in them instead? Because there is much hype around those companies.
Yeah, I mean, there's open AI and stuff like that. I don't look at AI. I look at AI companies that are actually helping real businesses actually solve real problems. I don't
Mhm.
need something that, like, okay, I need, here's something that Rahul sent me, reply to him automatically. That's the difference between something nice to have versus something you need. So an example is currently full self driving of Tesla is something nice to have. I can go without it, no issue. But something like something like a software suite that is AI based that is actually saving me margins on my business, that is something I need.
Mhm.
So you got to differentiate the two, nice to have versus something I need.
Right.
And that applies to AI quite a bit than anything else right now.
Right. Right. No, I guess what I'm asking is like right now, let's say Tesla, that's a big investment theme, full self-driving. Everyone's going and trying to buy Tesla shares, right? Let's just say again, this year's been rough for Tesla, but in general. Now, I know a lot of like really big investors, instead of buying Tesla because it's a crowded space, they'll look at companies that make the hardware for Tesla cars and they'll try to invest in that. Again, Tesla's a bad example, their own technology. But for example, let's say Tesla pursuing full self-driving, instead of investing in Tesla, they'll invest in Nvidia because Nvidia makes the chip for full self.
Yeah.
Do you ever look at investments like that, or is it for you? Is it just like two or three companies that you're really keen on that you kind of push for?
No, absolutely. Like Nvidia was something I looked at. I just didn't actually fully analyze. I do look for common denominators. How many sectors are they going to attack? So you have to know the difference between general purpose chips and then ASICs, application specific circuits, right? So it's just like Tesla is just application specific on driving, and then Nvidia is all across the market. There's a bigger TAM for Nvidia versus Tesla because Nvidia can just send chips everywhere. Now, to fight that, if I look at the other side, you can also say that if you have a big taxi network and Tesla's the most efficient car, then that Tesla becomes the chip because now you need a car to ship you anywhere because the only car that has the best autonomous driving enabled in it is a Tesla. So everyone who's driving a Toyota right now, taxi drivers, police, hospitals, they're all going to use a Tesla because it has the most efficient battery. So you can look at both pictures that way. But Tesla isn't there yet. They're going
Right.
to get there. But Nvidia already is there because it's easier to buy a chip. It's cheaper. You can actually start using. You can use it for gaming. You can use it for mining. You can use it for AI. You can use it for data centers. It's just too many options out there right now. Tesla isn't there because eventually you're gonna say the same thing about Tesla. Oh, you can use a Tesla car for Uber, for Lyft, for delivering furniture. You got the pickup truck now. You can use it for construction. You can use it for taxi. You can like. There's so many things in transport that you can apply to a Tesla as well.
Mhm. Your question for you: do you think it's good, like the apps like Twitter, where people are always talking about investing? Do you think that's a good thing or a bad?
It's a double-edged sword because you have shit talkers and then you have the good talkers, right? One or the other. Because the problem is that it takes a lot longer to put out a fire than to create one. So if someone posts something about something that is false, now you got to somehow mitigate it. But if it goes far enough, it's a problem because now it's fake news, which is spread and it's crashed the stock. So the speed is like a double-edged sword in my view. I can't say if it's good or bad because both.
Hmm. I feel like whenever I watch Twitter, I feel like a lot of people get phone because every other week there's the stock of the week that's running, right?
Yeah,
Rumble this
absolutely.
week, it's SoFi next week, XYZ company the following week. So like there, yeah, I totally get the double-edged sword because there's parts I love about it, which is the information that's being shared for free to everyone. Like to me, that's insane. Like the amount of value, like people that are really good at what they do, they just share this information for free. And then, yeah, the other side that's not so good is that every week some other person is pumping some sort of a stock or narrative, right?
Yeah,
And I think it
absolutely.
makes you kind of like second guess yourself, like, oh, I know Tesla's going to go far in the next 5 years, but I kind of want to participate in this pump and dump or whatever, right?
Yeah, you have to really like just like the internet, you have to like sift through it and just realize and figure out who's bullshitting and who's not, who's the troll, who's not, who's actually sending you good information, who's not. And then sometimes they will sell. The hardest part I find is that an expert in a certain field that I'm not an expert in will explain stuff and I will believe them. But then they will talk about stuff in a field that I'm an expert in and it's bullshit. And now you're like, should I even believe you on anything now? Right? That's the
Mm-hmm.
hardest part I find. So you have to like really, really be careful who you're listening to and what their expertise is. I'm not going to listen to Jordan Belfort on tech. All he knows is sales. So you have to know what their actual like strength is and then go from there.
For sure. You seem to have a lot of fun with the people on Twitter.
All the time.
There's a lot of PayPal and SoFi jokes that happen weekly.
Yeah, I'm just creating a book. I'm gonna release it one day and sell it to all of them.
Yeah. Yeah. You've also had Alex Chris respond to one of your tweets. Hey.
Yeah, I don't know why he followed me. He's asking for to be. He's asking to get trolled.
Yeah.
SoFi CEO followed me too a long time ago, and then I just kept shitting on SoFi nonstop, and then he unfollowed me. So maybe
Yeah.
this will happen to Alex Chris as well. Who knows?
Yeah. That's one of the things that I really love about Twitter is the fact that like you can connect to anyone anytime, right? People were just
Yeah.
posting Alex Chris and he started DMing everyone taking care of the PayPal customers.
Yeah, he's a good sport. I like him.
He's a sport.
Okay, I think we're past an hour. We should probably
Yeah, I
try
think
to
the goal
wrap it
was
up.
to go for 30 minutes and we went for about an hour now.
Karn's questions, man, I'm telling you, they're intense.
You're talking about Karn, the guy that doesn't talk that much?
I didn't talk about mumbo jumbo.
This was good. Oh, that's good.
Awesome. And then, guys, thanks for, I see we've got listeners here. Karn, Grogu, of course. Thank you guys for doing this. I want to try to do this more regularly. I'll try to do it, once every few weeks, so it's not like overwhelming. But I hope this brings value to people, and more than anything, like I said, if I learn something from it, then it's time well spent. So, can't thank you guys enough for doing this.
Yeah, I agree, and I got the same sentiments as you, Rahul. It's learning where to get the information is the most important than just to go and like obviously we have to start somewhere, but now Grogu, you've answered enough of my questions of essentially where I need to start and where I need to go instead of just asking those questions directly to you or other users. I'll just go and figure these things out. Market caps, moving averages, blue chip stocks when the market's going up or down. Talking to customers, I never actually thought about that, right? Sales margins, never thought about that. We just always look at what these top speakers are saying or talking about in regards to, oh, the company did really well this quarter, or they did poorly, or how are the end of the year reports looking, and just basing your portfolio off of that. So this was good. I really appreciate your time. I really appreciate you coming on. So thank you so much.
No worries, guys. Thank you for having me, and I appreciate you guys' time too. Thanks for asking all the valuable questions. We'll do it again.
Okay. See you later.
Take care, guys.
Thanks, guys.
Bye.